Hello and welcome to this video on interpreting financial statements, focusing on the statement of financial position. So in this video we're going to look at the design and the usefulness of a statement of financial position. So let's remind ourselves that we are looking here at financial statements, and the function of a financial statement is to provide information to stakeholders on how the company is performing. There are two key financial statements which record trading activities of the business, normally by looking over a period of a year. They're known as the Statement of Comprehensive Income, the Profit and Loss Account, and what we're looking at today, the Statement of Financial Position, the balance sheet showing assets and liabilities at a particular point in time. So let's quickly remind ourselves what a Statement of Financial Position shows us. It summarizes the assets, the items of value that a business owns, the liabilities, the debts, the money that a business owes, and the net worth of a business on a particular day at a particular point in time. So what does it show us? It shows whether a business has cash to pay its debt on time. It shows us about the liquidity of a business. It shows us about the financial flexibility potentially of the business to acquire finance. Is it in a position to take out more long-term loans or to raise more share capital? Is the business solvent? And is the business able to distribute cash in the form of dividends to shareholders? Does the business actually hold any cash that it can distribute to shareholders? So a couple of key terms here: liquidity, a business's ability to meet its short-term financial obligations, to pay its day-to-day expenses, and solvency. A business we'd say is solvent if it's able to sustain its activities over the long term. So a quick reminder of the statement of financial position. First of all, we list the non-current assets. So these are the assets, something the business owns that they're likely to hold for longer than a year. For example, land, buildings, machinery, vehicles. Then we look at what the business owns that's likely to be converted into cash within the next year. So these are short-term assets, including inventories or stock, so the value of that, money owed by customers, trade receivables or debtors, and cash the business has in the bank or in the business at hand. We add up the current assets to get total current assets. We then look at the money the business owes. We look at current liabilities, so debts or monies the business has to repay within 1 year. For example, to creditors, suppliers perhaps, or to lenders, short-term loans, overdraft. We take the current assets and subtract the current liabilities. We get the net current assets, the working capital, the amount of money within the next year the business should have spare. We then look at non-current liabilities, so long-term debts, for example, bank loans, anything that they need to pay back that's going to take more than a year. If we subtract all the liabilities from all the assets, we get the net assets of the business, essentially the net worth of the business at that particular point in time. Then to balance, we show the share capital, the money invested by the shareholders, and the retained profit. This gives us the total equity, so the value of the shareholders' funds within the business, and the total equity within the business will always equal the net assets of the business. So here's an example of a simple statement of financial position. We have the assets and the liabilities listed. Current, short-term within a year, non-current, long-term more than a year. Now we can look here from the total capital employed. So how much capital finance is the business using? And we can do that by looking at money that's come from shareholders, been invested, money that's come from the business previously, that's been reinvested, and also the money that's come from banks, for example, through long-term loans. And we add these three values together to get the long-term sources of finance, or otherwise known as the total capital employed. We can also look at total equity, which is the share capital plus the retained profits. And a reminder that any figure with brackets in a statement of financial position is normally a debt. Although, for example, when we calculate total capital employed, we had to add the 6,000 on, even though it's a negative. So it'd be 6,000 plus 8,000 plus 7,235. So why is the statement of financial position useful? Well, it shows us the short-term liquidity position of the business, i.e. is it able to meet its short-term debts coming up within the next year. It also shows us the long-term liquidity position of the business. What are the non-current liabilities? Has it borrowed an excessive amount of money, maybe making it vulnerable to future interest rate rises? However, it is a document that might not be a good indicator of what may happen in the future. It only shows us a particular snapshot in time. And it has the potential to be what we call window dressed. So businesses might kind of manipulate the figures in a statement of financial position to show a slightly better financial position than maybe they have. Again, an individual statement of financial position doesn't tell us too much. We need to really compare it to previous years or compare it against businesses in the same industry. Now, stakeholders may find the statement of financial position of use to them. And a stakeholder is any individual or organization who has an interest or are affected by the activities or the performance of the business. We have internal and external stakeholders, and they'll be interested in how profitable the company is, how much cash the company holds, how much of the company's long-term capital is in the form of debt and has to be paid back to a lender, and how much is from shareholders. So, in terms of stakeholders, they'll be interested in, well, they might be interested in the net worth of a business or the ratio of debt in the business to equity. Employees might be looking at the statement of financial position to see if their jobs are stable, if the business is stable and their jobs are secure. The management might be looking at liquidity, possibly, the year-on-year performance of the business. Customers will be looking at maybe whether the long-term position of the business is going to last. Suppliers, will we be paid on time? Can we give this business long credit periods? Or if their liquidity is poor, maybe we'd be more reluctant to do that. Creditors, be banks. How much cash does the business have to pay back its debts? And the government, has the business paid the right amount of tax? So in this video, we've looked at the design of the statement of financial position and also how it might be useful to stakeholders. That's it. Thank you very much for listening.